Hello, everybody. My name is Bennett Tchaikovsky, and welcome. This is my next video over here of external financial reporting and corporate social responsibility. This is for my Accounting 262 class, and we're going to be talking about here in today, part one, why do companies decide to go public? So my disclaimer and copyright notice, the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College in the South Orange County Community College District. Presentations for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Note that this presentation will refer to companies and other parties or the third parties. I do not claim any copyright that belongs to those third parties. So, why do companies go public? It's the need for capital to run your business. And the less you need money, the more you're going to be in control of your own destiny. Going public is extremely expensive. But if you take money from investors, those investors are going to need an exit. And just in terms of, as far as why do these companies decide to basically is to go public, again, they may need additional capital. It could be that it's much easier to raise money if you're a larger publicly traded company as opposed to being privately held. But one of the things about going public is you may end up basically losing control or of your ownership. And I'm going to talk a little bit about that in just a moment. So when we talk about the loss of control, let's just go take a look really quickly because back in 2022, Elon Musk purchased Twitter. And if we go over here and we search up Twitter, what you're going to notice is on Twitter's financial statements, and we can just pull one up over here. Okay, so what you're going to notice is that with Twitter, their stockholders' equity, there was just basically common stock, a certain amount of shares that had been authorized, a certain amount of shares that had been issued and outstanding. Note that for publicly traded companies, the Securities and Exchange Commission, in my experience, has generally frowned upon companies issuing preferred stock. However, what the Securities and Exchange Commission or the SEC is okay with is looking at different types of classes of common stock. We are right now looking at Twitter. Elon Musk was able to buy Twitter in 2022, right? And in doing so, he didn't have a huge trouble in terms of going through and doing that, mainly because there were just common shares. If I buy a share, it's going to have one voting right. But if we look at, say, another company, and we're going to look over here at our friends at Meta Platforms, which is the old Facebook. When I look at Meta Platforms, if Elon Musk said, hey, I want to buy Meta Platforms, he would have had a huge problem. Why is it a huge problem? It is because when you look at Meta Platforms, they have two different shares of common that have been set forth. There is Class A shares, and these were sold back in Facebook / Meta's 2012 public offering. And they have Class B shares. These shares were basically issued to insiders. And if I go through and look at Class B as to basically over here, So here's the big difference. Our Class B common stock has 10 votes per share. And as basically Class A common stock has 1 vote per share. So essentially, if Elon had tried to go through and buy Meta platforms, that would have been a huge mistake because there's no way he could purchase enough shares to get voting control. So going back to this, and this is so important, is like if you are looking to go public, and again, it depends on the leverage you have. When Facebook or Meta Platforms was going public, they were a hot item, meaning that the investors like, and they still like Mr. Zuckerberg, and they were willing to give him and allow him to keep control. If you have heard of stories about Steve Jobs being booted out of Apple, back then it's kind of the same issue that happened to Mr. Dorsey at Twitter, is that, hey, he did not have control of his company. So, when you look at this, when you're looking at investing in companies, if I'm investing in Meta, I'm really investing in Mark Zuckerberg because Mr. Zuckerberg is going to be the one who's going to be running that thing for the indefinite future. So it's something that you want to think about when you're going through and either making an investment into a company, or if you're thinking about taking over a company, you got to kind of look at what that capital structure is. So that's a real lot about more about control. But again, if you do sell stock and if you do end up diluting, you may lose control of your company. So what are the other things that you'll kind of hear kind of coming around is you will also see things about angel investors, friends and family, crowdfunding, other corporations, right? So Amazon invested money into Rivian. Whenever you look at this, if you're taking money from others and you are a private entity, most of those people need to understand is that they can't get out of their investment until your business is either sold or you decide to become publicly traded. So when you go to an investor seeking an investment in your business, they need to understand it is really risky, hugely risky. And it's just because, hey, you may not get your money back. And that's why when you are soliciting money from investors, you generally need to make sure that that investor is something called accredited. Now, meaning they have a certain net worth, they make a certain amount of money every year. But even before we kind of get into that, again, I'm not giving you advice for going through and raising money. It is just extremely complicated, right? If you start soliciting people outside of the state that you're in, like, so say I live in California, I want to solicit money from somebody who lives in New York. I may have to be registered as a New York, basically in New York, in order to accept money from a New York investor as a privately held company. There's something called blue sky laws. So in this entire process, you need to make sure you're, getting the advice of counsel. Now, what my job is here to do is to give you an introduction to these concepts. So hopefully you can go out and, do what you need to do. But there are a lot of laws relating to the sale of securities. And this is oftentimes a federal matter. And the feds love to prosecute this stuff. So don't mess with the feds. Okay. Now, again, when you think about it, it's really about your exit strategy. And I'm going to point this out here. When you're investing in a privately held company, you are not going to be able to have your investment monetized for a period of time. Therefore, you have to be very, very careful as to what you are going through and investing in. If your friend says, hey, I'm starting up a company, will you invest in me? you probably, if you have money that you don't need and you don't really care about, and you say, hey, I was going to take this $1,000 and go to Las Vegas, or I could give it to my friend to help him start up his company. I would probably give it to my friend because you're investing in the people you love. And that's going to be a better thing. So, I'd rather do that than taking it to Las Vegas where I would probably lose everything. But again, when you're investing in a company, and if you're forming a company, you've got to be thinking about what is going to be the exit strategy. How are these people going to get their money back? So that's kind of the first part of this, is really kind of, and hopefully I touched upon this enough. Why do companies go public? It's essentially to give liquidity to investors. But again, you don't have to go public. You can be acquired by another company. There's a lot of different things that can kind of happen. But again, this is about external financial reporting. So we're going to be talking about publicly traded companies, hence the discussion. So thank you for watching. Please remember to like and subscribe, and I look forward to seeing you on the next video. Have a great day.